Okay, let's start. Okay, guys, first of all, Merry Christmas to everybody and a Happy New Year, and I hope the next year would be a very healthy and wealthy and a prosperous new year to all of us. And in that spirit of joy for the next year, and thank you, Paul. What I'm doing, guys, is as you all know, that every once a year, at the beginning in January, on the first, we do the trade planning session every year, or we do it every Sunday. Let's do that. And this year, I was thinking of what kind of a present or a gift that we can share to all of you, and this is my gift to everyone at FX Street. You guys are what we are going to conduct. I'm just going to put it up again so that you can. We are going to do a New Year trade planning session where we are going to analyze the whole market. We're going to look for the major trends, and we are going to identify the probable moves for the next year. As I said, this is a gift. There is no strings attached, nothing whatsoever. We're going to spend about 2.5 hours. We expect at least to be a very large number of people attending this session. This is something I do once a year. And all of you, this is my gift to you, and Merry Christmas and Happy New Year, and I hope to see you. We're going to do it on January the 3rd at 7 o'clock GMT in the evening, and anybody who's FX Street can just go there, sign up, and as I said, this is my Christmas present to all of you. All right? So, Merry Christmas and a Happy New Year. Now, let's go and start doing some trading. My pleasure, Paul. Okay, so now you have, in trading today's session, we're going to try to trade the New York session. We did yesterday, as I said, what we do every Sunday, our trade planning session, and it is extremely important that you guys come into the Monday morning prepared and knowing what you're going to do in the session, whether it's London or New York, whatever session that you trade. You have to have a general bias towards the market, and we identify, like I mentioned to you before, basically what we call the buying point, the long point, and the short point, and the structural long and the structural short. And the premise behind doing this, I saw somebody was talking earlier that he wanted to attend the price behavior session. The premise behind doing that is quite simple. Trading is, for us, or the way we trade, we try to simplify it and accept a couple of basic points. The primary point that we all have to accept as traders is our inability to predict the future. There is no indicator that has been created. There is nothing that can tell me if the price of something is going to go up or it is going to go down. And if you and I can agree that we cannot predict the future, then with that same premise, if I cannot predict the future, so there is no reason for me to try. So I will not suffer let's find a better word than suffer, but I will not, if the prices go in a different direction than my expectation, then I wouldn't say that I was wrong, and I will shoulder that burden of making an error or making a mistake. All what we know that we cannot predict the future. So with that, for example, let's take the dollar yen. This is one of the very unique setups, and I'm going to share this with you today because I think it is one of the rare events. I'm going to share with you two basic currencies today, which are events that they happen, multi-year. I mean, they're not something that happens every day, and they are quite a rare event, and I want to share them with you, and I want to share them with the FX Street traders, because as I said, it's kind of a unique event, and it's a rare event, and it's quite important event. So going first to the dollar yen, you can see that we have, let me explain what we call this light blue lines here on the chart, and this is all the technical stuff that we use in our trading is simply the horizontal line, because it brings things, good afternoon, Carl. It brings things into perspective, and it allows us to see things and make our trading decisions. These lines, or any line, basically is a decision-making point. So assuming, let's say here, again, I'm using any line as an example. Above that specific line, I have only two decisions: buy or nothing, or do nothing. I have two choices, either to buy or to do nothing. Okay, and below the line, I have two other decisions, either to sell or do nothing. Buying is no longer an option. So if I do that, that is the essence of how we trade in price behavior, because we agree that we cannot predict. So in order to become successful traders, we have to take the high probability trades. We have to think in probability. Because if I am able to think in probabilities, then I have to increase my odds of success. And increasing my odds of success, I have to limit the situations where I can lose. And therefore, if I take away the situations where it is going to be a losing trade for me, then I am increasing my odds of success. Let me explain that. I'm sure some of you heard me say that before, but I'm just going to say it for the newcomers. If we're looking here at the where I have the question mark, and I ask Paul Volcker, what do you want to do at 83.17? Well, Paul has three situations, three choices. He can buy, he can sell, or he can do nothing. So he can only be right in one decision out of the three. This means that his odds of succeeding or making money, when we call succeeding, I mean, let's say the odds of making money, because if you don't predict, there is no failure. The odds of making money is 1 out of 3. So your odds of making money is 33% of the time, and your odds of you not making money is 66% of the time. Or if you're going to actually, let's say you're not going to make money or lose money, so you're getting into a business that 66% of the time you're not going to make money. This is not a good business to be involved in. So what we do is we identify what we call a reference. And let's say that this is our reference point, the 8710. It's an arbitrary number. Let's say I tell you guys, Paul, the number we're going to use as an arbitrary number or as our reference point is 8710. That means that above 8710, your choices now, so right here, where I'm going to put the question mark, the second question mark, your choices now are no longer buy, sell, or do nothing. Your choices are either to buy or to do nothing. You only have two choices. Selling is no longer an option. You can either buy or do nothing. Selling is no longer an option. This means your odds of making money, you only have two choices, so the odds of you making money is 1 out of 2. So this means by defining a reference point and defining that our decision to trade above that reference point is limited to 2 options, we have just changed by that process our odds of making money from a measly 33%. We have raised this odds because it's 1 out of 2 to 50%. So now you have an even chance, a 50-50 chance of actually making money rather than you having only a 33%. Plus, when you add upon it some more money management and risk trades, then you will be able to raise your odds of success from 50 to actually much more higher. And now you have a system or a business that you can trade and at the end of the day make money. Okay? So that is what we mean by thinking as probability, and that also what means that we are not going to shoulder a trade, or we're not going to measure the trade or assess the trade by its outcome. If I took a trade and I made money, that's fine. If I took a trade and I followed the same rules and the same procedures, then and it doesn't come up with a financial gain, this does not mean that this trade is a bad trade. All what it means, it is one of those probability. If I have 50-50 chance, this means if I'm going to take 10 trades, 5 of them are going to make money and 5 of them are not going to make money. Do you follow what I'm trying to say? So if I take a trade, let's put it this way. Let's say we come up with a system that I'm going to make money, and I want you to see this. This is how you think as a trader, guys. I mean, I don't want you to think when you're coming into the market to trade that you can predict the future. You can predict the next direction of the price. Your job as a trader is 2 things. 1, take the high probability trade only. That's your number 1 job. Your second job, these are the 2 responsibilities that you have, is to control your risk. These are the only 2 things under your control. You have nothing else that you can control. Nothing. 0. These are the only 2 things that you can decide, you can take action upon, and you can control. You can force yourself to take the high probability trade. You can force yourself to identify the high probability trade. And if you do not take the high probability trade, you have nobody else to blame but yourself. You can also, and you should, control your risk. If you do not control your risk, then your losses are going to be spread, and then you have nobody else to blame but yourself. The mark of a trader, the number 1 thing a trader who plans to be successful in this market has to do those 2 things. And then the third thing, which is part of he has to take ownership for his decision. He has to take ownership for his trading decision. You have to accept that you are the one that took the buy, you made that decision, and whatever the outcome is, that is the outcome. You have to own that decision, because nobody can put the buy except you, and nobody can put the sell except you. So you have to be able to accept responsibility. And in order to be able to survive this market and accept the responsibility every single day, and be able to come back to the market and come back to the market and trade and trade and trade, is that you have to do 2 things. You have to take the high probability trades only so that you increase your odds of success, and you only need to control your risk. So the risk has to be small so you don't lose too much money. Okay? Now, having said that, if I come here now and I say to you, let's say for example Joa, that we are going to be buyers above the 87.10. I want to just explain this quickly before I take you to the unique setups. We're going to buy above the 87.10. This means now that that is a high probability trade, and I'm only taking the buys, or I can decide to do nothing. If I do nothing, I'm not going to make money anyway. But if I am going to buy above, and this is the beauty of how to identify price behavior and how to become successful with price behavior, because it solves all or most of the questions. Buying above 87, this is how we train you on how to identify what the 87.10 is as a high probability setup. But once you identify that above 87.10, you're going to buy because it is above 87.10. So I want you to answer, guys. So what is our reason now that we're buying? Can anybody tell me? Why now are we buying? Because above 87.10, that is the high probability. Okay? So the reason we entered into the trade is because that the prices are above 87.10. So if the prices come back and trade for whatever reason and come and trade below 87.10, do I still have any reason that I should stay long? I bought because the prices are above 87.10, and since the prices are above 87.10, this means that the high probability is up. Exactly, Joel. So if the prices come and trade below 87.10, I no longer have a reason to stay long, and now I need to get out of my long position and I need to exit. Do you follow what I'm saying, guys? Yes, no, maybe? Okay. So what this has done, when we have done that, when we identify, when we identify that above 87.10 is my, not exactly 2 ticks or 2 pips underneath it, tip top, you have to give it, this is a $3 trillion market. You have to give it a few pips. You have to give it a breathing room. So probably maybe 20 pips or something like that. You just have to give it a little bit of room, because if a trader in a bank just pushes his button to buy a billion or sell a billion, but you don't want it to go above 87.10 and then come back and trade for a long time, you just get out. So what I have done now, guys, is we have done basically the 2 things that we're supposed to do, and that is what we have identified: the high probability trade. So we are going to buy above 87.10, and we also identified that if it gets below 87.10, I'm getting out of the trade. So the 87.10, what it did now, it controlled my risk. Because like Tip Top said, he wants to get out 2 pips away, and I said, no, give it 10, 15 pips. So we both know that we're going to go out below 87.10. It's just the size of the stop. Is it 2 or 15 or 20? So what that did is It controlled, we took the high probability trades, and at the same time, we were able to automatically, by identifying this reference point, identify and control our risk. And that's our job. That's all what we have to do, is to take the high probability trade and control our risk. Because if we have a system that works, let's say, 60% of the time, let's say I'm going to take 10 trades, I'm going to make money in 6 of them, and I'm going to lose money in 4 of them. Okay? 60%, I mean, this is as worse as you can get. I mean, the worst, I mean, if you trade anything, even 50-50, you can still make money, but 60, let's say, it's acceptable. So if you're going to make money on 6 trades, and let's say you make $3 a trade, which you should make more than that because the high probability should pay you more, but let's say 3, you're going to make $18 at the end of the day. And if you have 4 losing trades, and let's say you're going to lose $1 per trade, so you're going to end up losing $4. So having done the math, making, let me edit this so that this is, so having, this is the mindset of a trader, guys. This is how you think as a trader. So now I took 6 trades, I made $18. Yes. It does. It is a reference point, Abel. It is a reference point. It's what we call it. But let me finish this. So right now, if you took those 10 trades at the end of the day, and now if you're going to add up your profit and loss, now you made 18 and then you lost 4. So at the end of the day, you are up. So if I'm going to do the math, so at the end of the day, you are up $14. Do you agree with the math? And that's what trading is all about, is math. So in this case, if this is the numbers that I do, and this is all what you have to do to make your risk-reward ratio 3-to-1, which is the worst, you should be able to make it 5 and 6 and 10-to-1. But let's say we're keeping it 3-to-1. Now, when you took 4 losing trades, are the 4 losing trades bad? Are they losing trades? Should we think of them as losing trades and we avoid trading in the market? What do you think, guys? Absolutely. It is the cost, exactly, PFX. It is the cost of doing business. It is the cost of doing business. You go to your office every day, you take your car, you buy a car to go to the office. That's part of your business. You pay gas every day to go to the office. You go to the office, you rent the premises. You pay rent. You buy furniture. You pay for electricity. You pay for your secretary. You pay for the rest of the people that are working for you. You buy a computer. You hook it on the internet. You open an account. All of these are costs. It is your cost of doing business. So, instead, in this gorgeous business that we are in today, which is trading, those 4 little losing trades are, instead of you paying rent, are instead of you paying gas every day, it is instead of you paying salaries to assistants and employees and staff and whatever it is, these are the costs. And it's your job to keep these costs as small as possible. because the smaller you keep them, the more money you're going to make at the end of the day. So do not take a losing trade personally. There is no right trade and there is no wrong trade, because you do not know. If I ask, I usually say this in the class, and some of you taken the course with me, and one of the first questions I ask people is, we bring lunch into the office, so I say, do you know what you guys are going to have for lunch today? And I said, anybody that knows what you're going to have for lunch today, raise your hand. Of course, nobody knows what we're getting for lunch today, so nobody raises his hand. So, if you guys don't know what you're going to have for lunch today, how, for heaven's sake, would you know that the euro is going to go up or the euro is going to come down? If I don't know that, why should I try? If you know we're guaranteed that we cannot, so let's not try. So anyway, that is the part of what I'm going to discuss about the mindset and how to trade using the way we trade as price behavior. Then we're going now to see how to apply that. So looking at this here, now the 8710, I think who was asking the 8710, blah, 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 Abel, it doesn't look like a reference point. Any line on the chart here, Abel, that you see on my screen that is light blue, that is a reference point. And if you look over here, you would see that this is the origin of the 8710. It's back in January 2009. Okay? So it is definitely one of the very important reference points that we use. So anyway, let's take a look here at this chart. And we have two reference points on top of each other. And trust me on that they are. And you can write them down if you want to use them in your trading. One is the 84.80 for the dollar yen, and the other one is the 84.40. And you have those two structural points, what we call significant points or structural points, right one on top of the other. Sitting, this is like a big heavy ceiling that is laying on top of the dollar yen, and it's preventing the dollar from going higher. And it's sitting right on top over here, and as you can see, it began testing it from November. The first test was on November the 29th, and it's been trying 1, 2, 3, 4, 5, 6, 7, and then it broke down 7 times in the span of 2 or let's say 10 trading days. It has been trying to go to pop above the 84.40, and it looks like as if somebody is pushing, just every time it raises its head above the 84, somebody is pushing the dollar yen to the downside. And that is good because, and if you see here, and then you have the other point, which is the 84.80. So in between those lines, why do you think it's creating that? Because there are a lot of all of these sell orders are sitting above the 84.80 and sitting exactly orders and stop. Brilliant. There are some of them buy orders, and in this case, since they're pushing the market down, there is a lot of sell orders. Brilliant. Now we're beginning to see things. If now I have orders sitting above, let's take now this Look at this. We agreed that above here there are orders. So let's take this candle here, that day. Now, Paul and we have just explained to you that above 84.80 there are sell orders and there are buy orders. If there is more buy orders, then this thing is going to fly up. If there is more sell orders, then this thing is going to come down. It's simple common sense, right? You and we don't know which way it's going to go. But take a look here. On this day, it went, the day before it went above the 84.80 and it came back. So we know on this day that the sell orders were much more. So on that day number 2, when it goes back above the 84.80, which is the significant point, and it fails again, what should we do, guys? It's a no-brainer sell. Because the second time, again, the number of times, it did it yesterday, it failed and it started crashing down, because now I have this, and now we're able to identify the barrier between 84.80 and 84.40. So what you need to do is, okay, so I tried it again. So in this case, it comes back below the 84.80, 84.40. So now, guys, look at this. Above 84.40, that's the high probability to buy, right? Look at what I did before up here. What we had on top here for a second, right? Take the high probability trade and controlling our risk. So above 84.40, we're supposed the high probability to buy. Below 84.40, this is my exit and my risk. And now, knowing it is going to come down, so I'm going to buy it above 84.50. It comes below 84.40, so I lose 10 pips, like Tip Top Trader was saying. So now I lost 10 pips. But I also have additional information. I have valuable information. If I get stopped out and do nothing, I will end up the day losing that 10 pips. But since I paid for the information and the market is telling me, Mike, I am not going up, and I just cost you 10 pips to tell you that I am not going up and I am now coming down, what should we do? If I have went to an informant and paid for some information, and the informant took the money, and I have the information, exactly, then the next step is act on this information. Otherwise, it is going to be a total loss. So right there, you would take it short over here, and now from 84, it took you down to the low of the day of 83.80. Exactly, you made 60 pips. Your investment in cost by taking the high probability trade, identifying your exit or your risk, you gained information that cost you, let's say, 20 pips. Now you have to take the second exit and you go short, and now you make 60. So in this case, your total gain, your gross gain, is plus 60. Your loss is, let's say, minus 20. Now your net is plus 40, and therefore the $20 or the 20 pip loss is not a loss, it's a cost of doing business, and you made it that day $40. That's how it's done. So this is one of the setups that we identified, and this is what we do every Sunday. is that we go through these levels and identify what we call the structure point and the significant points, and these become our decision points to make our trading decision. So I'm going to show you now what we did yesterday, for example, for the dollar yen. See, our buying point is the 84.40. We're going to buy above 84.40, and our structural point to the upside is the 84.40, and we're going to go short below 83.60 if it comes below 83.60, and we have a significant short which is the 82.87. And as you see right now, we're still sitting at 83.60, so the price now is at 83.70. It has not triggered our selling point, so I don't need even to bother by going short the dollar yen. Even though it is coming down right now, it is a weak selling point. It is not that big a selling point. If I wanted to take a short over here, you can take it as a scalp, but you know you want to maintain a bigger bias, and you see it is still sitting within the range, so it's not really an exciting. So let me see what's going on into the market today. And the radar screen is one of our very powerful tools. It just gives us clarity in the market, which is moving, but just by scanning this in a second, I can know what's going on. So the one that's kind of moving, I mean, the euro dollar is just 11 pips to the upside. The euro Aussie is 10 pips. There is nothing happening in the Aussie pairs. The euro pound, nothing is happening. So the session is still kind of slow. So anyway, let me show you the euro, because it's a brilliant what happened with the euro the last couple of days. It's simply brilliant, and let me show you. It's very similar to the situation that we had in the 80.40 and the 80.80 over here, but you will appreciate that these are trades that we took here in the there are certain confirmations that we look for, John, but all these information that the confirmation factors and stuff like that there are several conditions, but primarily for the sake of, because I don't want to give you so hypothetically, for example, look here, you see this red line? Okay, this is a very good example, a good question, John. Let me explain that to you with a little bit of detail, I think for the benefit of everybody also. If you look here, this is one of our structure points, which is the 33.37. If you look at the Abel, I mean, just look at what I'm again. I mean, this is stuff that we just take a look at the 133.78. Now it's pretty much similar to the 84.80. Think about this as replace it with the 84. This is what we teach in the course. It's much more, there is more to it than just its structure, price, behavior, or all that. There is more. But if you look at this point, guys, this is like the 84.80. And I will show you the trades. 1 second, right there. So, if now above the 133, this is where going to be our decision is going to buy, right? Or nothing, right? This is our decision above the the 133.37, we're going to buy or do nothing. Okay, and below that, so this means if it gets above it, like the 84.80, what we did in the dollar, we're going to buy. Do you agree, Paul? And tipped up above, because it's exactly like, and that is what price behavior is, guys. Because price behavior is a behavior. It doesn't matter if it is the dollar, the yen, the pound. It's a behavior. Above that, this is how it behaves. It should fly. If it doesn't fly, then the market is giving me information. If it's giving me information, then it's my job to act upon this information. That's what price behavior is all about. No subjectivity. No, it is a divergence. And this divergence, I think it's a strong divergence, or I think it's a weak divergence, or it's that subjectivity opens things to interpretations and to analysis. When you're trading, you're not in the business of analysis. You're in the business of making money. You need clarity. You need decisiveness. And you need action. And you need to be strong so that the loss doesn't affect you psychologically. So that the loss is, does it hurt you to pay the rent, to write the check for the rent? Nobody likes to pay money, but still I'm paying the rent check. It doesn't bother me. I know that every month I have to pay the rent check. It doesn't bother me. It doesn't say I'm not going to the office every day. I have to sign the rent check. So in this case, your rent check is the trade that doesn't work. That's your rent check. You have to be strong enough to pay the rent check and to take the next trade. You need to make more money so that you can pay next month rent. So right here, above the 137, in a way, Lancer, yes, you want to buy. Well, I'll show you. Let me wait. I'm trying to show you. I'm just trying to put you in the right mindset, and then I'm going to show you. I'm going to show you the trades, and I'm going to show you the trades that we took. Hold on a second. So, just stay with me. Above here, you want to buy. And your stop is right below that. If it fails, you're going to get out of the trade and you're going to do what? Take action on the information and go short. Right? And look at this. It went up. All the day before it was going up. As soon as here, and it turns around, you're going short at 133.37, and you took it all the way down. It closed, let's say the close at 132.50. Just by this trick, you made 110 or 120 pips. How many trades a day that you can catch 120 pips on? Now let me show you how it's played. Now you can see here, let me take this red line out. You can see here, this is our 133. Well, if it oscillates, it oscillates. It's another behavior, it oscillates. There is no one cookie cutter, Lancer. But at least if you know what you're looking for, you can tell if it's oscillating or if it's not oscillating. There is no cookie cutter, guys. There is no pill that somebody can give you and you have every answer. This is like driving your car. Which part of the world are you, Lancer? Where are you from? You're driving. You go every day from your office, from your house to your office. Every day you drive. You go through the same route. But do you expect all the drivers on the same street are going to behave the same way every single day? Isn't sometimes people are moving fast, sometimes they're slow, sometimes there is congestion, sometimes. You have learned now that to adjust to these behaviors, if they're oscillating or not oscillating. It became a second nature to you, and you go down to your car every day and you put the keys in the ignition and you drive, and it doesn't even bother you what if the market is oscillating or not oscillating, or the traffic is going up or down, or whatever it is, because now you have accepted that that is the way they are. So there is no cookie cutter, and the one that taught you how to drive couldn't tell you that the only way people will drive is going to drive this way. Trading is pretty much like driving. There is no cookie cutter, but you have to learn how to drive, know your reference point, and adjust. So if we're going here, this is your one, this is the number here. So right here you're buying, right? Or do nothing. And if I move like this, and our stop is over here, how well do I do? How well? I'll show you. But the room is not open to the public. We don't open the room to the public. The room is only for the traders that follow, that have taken the course, and so we don't do the room open to the public, because all the people that in our trading room, they trade live money, and therefore I cannot waste time by explaining what the blue lines are and what is happening and what is the 133, because they are putting live money. But let me show you how much money we make. These are the trades that we took on that day. No, it's not a funny question. It's just people don't believe their eyes. That's all, which I have no problems. People like to see things complicated. Now, just for your reference, Mr. SW or Miss SW, whatever it is, are you familiar with TradeStation? This blue line indicates a winning trade. Thank you, Hamad. I appreciate it. Hamad is one of our traders. If you look at this here, this is the trade. You went short at 133.89, and you closed the trade at 132.32. So that is about 100 pips on that trade. Then the next point, the next day when we're going to the 133, these are intradays. We're trading the London session, so we're not taking them in the session. We're trading the New York session. But this is the next trade, the next New York session when it broke again. You took the second trade down from the 132.32 all the way down to the 130. So you have about another 30 sessions. So I just want to show you the 133 trade, which is up here, because that is the trade that you want to see. Look at this here. This is the first time. This is what I was telling you. And this is how exactly we trade. I'm going to show you the winning trade, SW. It's okay, SW, guys, we're not, this is a room for everybody to discuss and ask questions. There is no reason for anybody to be angry, guys. SW is entitled to his questions like anybody else. So focus, stay with me, SW. This is my room. I'm the one doing the presentation. Don't get angry with anybody. All right? Take a look here, guys. Right here, this is how we trade. We said we're going to buy if it gets above the 83, the 133 right there. So we did buy it at 133.31. Absolutely, there is no negativity in your question, SW, and I'm more than happy to answer it, and I'm answering it. So just focus with me, don't get distracted. Thank you. If you look here, SW, we follow a procedure, we follow rules. And the rule is, like I explained to you, above the 133.37, I'm going to be a buyer. Here, we have some conditions in the way we trade and the way we train the people that has triggered the buy signal a little bit early. So we bought it at 133.31. And now we are expecting it to go up above the 33, 37, and it did. And the gentleman, I think Lonsor, was asking me, do I immediately buy above the line or not? So the answer here, Lonsor, is I buy immediately when it gets above the line. But it turned around, look here now, it turned around and it came back in. So I immediately closed the trade. And you see this dashed line, this red line? This red line means that this trade was a loser. I lost money on that trade. Look at this. I bought it at 33, 31, and I sold it at 17. So I lost on that trade how much? I lost physically 20 pips, let's say. You see that, SW? I took the trade right before it. It turned around because it's not, and I'm waiting for it to go up. It came back inside, so I had to close the trade and get out. And at that moment in time, this trade SW is, no, hold on, I'm not finished yet. Now this trade is, did we get information from this trade SW? Yes, we had a piece of information that above 133 we're going, we had an information. That's the beauty of price behavior. The information is we're going to buy the high probability it's above 133, it should fly. So it went above the 133 and it did not fly. So it has to go up or come down. So the information now the market is telling me, SW, I'm not going up. SW, you paid me now 20 pips for me to tell you I'm not going up. I am doing what? I am going down. And you look at these two lines that you see here is another reference point that we use. And right there, it's coming below the second reference line. And so right there, what should you do right here, SW? Now you have the information, it's not going up. It is now coming below the second reference point. Absolutely. So you should take the short, and this is what we did. We took the short right there, 133.05, and we closed the trade. Right there, it's a blue line, so it's a winning trade, and we closed it at 132.50, and just rounding the number. So we lost 20 SW, and following the rules, we took another trade that made 50. So the cost of doing business is 20 plus, and the gross profit is 50. My cost is 20. We netted the day on 30 pips to the upside. Okay, and then now it breaks again, or either way, we're going to take the trade. Right there, it breaks again. So we took it short again, and there is the other trade from 132.49, and we closed the second trade at 131.50. So that's another 100 pips. And these are right in front of you. I'm just doing it because somebody asked about the trades and how we're doing. Every blue trade that you see there is a winning trade, and all of them is following the same set of rules that we follow in our trading. And again, we choose the market in the morning and we decide. But this is what the whole idea about price behavior and identifying the behavior. Now, trades like this, for example, today we didn't take, or we wouldn't be taking those trades because they don't follow. It's not no, again, you see the question was, some guys were saying, should I buy it right on top of the line or should I buy it below the line? When should I buy and when should I? And I was telling you, give it 10, 15 pips below. When we were talking about the 84.10, I said, don't put it at the 84.08, give it 10, 15 pips. You have to allow the market a little bit of breathing room. Okay, so right here, when we bought it right here, I had to give it 20 pips at least below the 133.37. So if I'm going to give it 20 pips below the 133.37, what will my stop be? If you subtract 20 from 37, it will be 17, 130.17, right? And if you look here, where did we go out? Look at the stop. 133.17. You just have to follow the rules. And as long as you don't take the loss personally, then you can just act on the information. No. Okay, let me clarify that. Guys, we're not in the business of selling software. Okay? Just to be clear. We're not in the business of selling software. And if any of you wants to come in and buy the software, I will be the first one to tell you not to buy it. There is no point for you. That's why 99% of everybody that buys a piece of software in the world, or a robot or something that this is the perfect system and I have a 98% winning ratio and all that kind of stuff. If you buy it and you don't know what it is doing, you have no idea why. I mean, I showed you, for example, here that we got out of the trade at 131.17 for two reasons. What is it? Right there, because it is 20 pips below the structural point. I explained it to you and you understood it, so now you can exit. No, you can trade it without the software if you understand the rules. Absolutely. You can come in, if you know what it does, you can do it. The software is like your autopilot. You have to know how to fly the plane, what are the rules are, when to make your decision, boyki, and then apply it. What the software does, it makes your life easy. It facilitates things. It allows you to make much better trades. It allows you, for you to become successful in trading, especially in today's market, you need 5 things. Simply 5 things. And these 5 things, you have to do them with perfection, with precision. Well, this is that's what we call it. That's the radar for the Forex weather. That's right in front of you, Boyki. That's what we do. That's the radar. But before we get to the radar, you need, as I said, 5 things. The first one is you need a set of rules. And these set of rules, you need to test them with your eyes to know that they work. And if you know that they work, then you develop a level of confidence in those rules. And you develop the skill of continuously applying these rules. And once you do that, you become consistent. If somebody tells you, if you go to anybody and says, in order to be a successful trader, you have to be consistent. right? Have you heard that before? Have you heard the term, and I'll just put yes or no. Have you heard the term, you must be consistent? Okay, brilliant. Now, can anybody of you explain to me how can you be consistent? What does consistency mean? How can you be consistent? Define consistency to me. Consistency is following, again, the rules, and you need to have, exactly, and you need to understand these rules, what they do. So, if you look here, let me show you what consistency means. These are, without me going into details, these are what we call levels or whatever. Okay? So whether they are the yellow or the magenta or the blue. Okay? Hold on a second, guys. Hold on a second. I just want to explain something to you. Exactly, guys. So I want you to count with me. I want you to count and keep the count to yourself. Every time it goes above one of those, you take the trade. If you make money or you lose money, it doesn't work 100% of the time. And every time it breaks below it, you're going to sell it and take it short. Okay? That, just do it with your eyes now. Every time it goes above, you take a buy. Every time it takes below, you take a sell. And I'm going to scroll back, God knows, from here. I don't know how far back I went. I went to November, 15 days. So here you have that is one winning trade, one sell, two sell, and see how big the moves are. 2, 3. You can say that this is a losing trade, so you got 3 and 1 loser. 4 winners, 1 loser, 2, so we got 4 and 2 losers, which they're not. 3 winners and 2 losers. 4 winners and 2 losers. 5 winners. 6 and 1 loser, so it's 3. You got 2 here, winners, so 8 and 3. 9, 10, 11, 12, and 1 loser, so I got 12 winners and 4 losers. 13, so 13 and 5, 14 winners, and see how big the winners are, 16. You get the point. So this, now you have seen that you got 16 or something that's giving you 70 or 80% of the time, and every time it goes, you're getting a big profit, and when it's losing a small profit. That means that now, in order for you to succeed using this system, you have to take every trade, because again, we don't know which one is going to work and which one is not. We take the probability. So now you have something that works about 75 or 80% of the time. So that is one of the 21 rules. We have 21 rules. And the rules is this, you have to take it every time. This is the meaning of being consistent. If you take every time you see that developing, you take the trade, you're being consistent. Look at this. Look at these trades. Now you can say to yourself, I am consistent. I am doing this every day. Now I'm following that methodology consistent. And we have, as I said, 21 rules. Of course, we do a little bit of scaling in. So the other thing that you need, guys, is the second most important thing is following these rules. And you become consistent. Then you need something else. Number two, you need what we call portfolio selection. Portfolio selection is the most important thing after the rules, because you use the rules to identify your portfolio. What are you going to buy and what you're going to sell? Portfolio selection is key. Some of you guys, they tell me, I only trade the euro. Somebody says I only trade the cable. Somebody says I only trade the Swiss. I only trade this or only trade that. That is disastrous. You would have your favorite pet currency that you understand, yes, but what you cannot trade it every single day. Look here. Look at this. This is the euro. You take it short over here, today, that day, you made money. If you take it here, you didn't make money. I have to be able to choose if the euro is going to be moving today or not. And there are rules that we have set. So you need to do your portfolio. So today I will trade the euro. Tomorrow I will trade the pound. The rest I will be trading the Aussie. Whatever is moving, I will identify that as my portfolio, which currency that I will be trading today. And that is the one I should be taking. And that is what we call portfolio selection. The other thing that you need is is optimum entry. To be in the trade at the best possible time, the moment your signal is triggered. Because when you get in at the right time, your stop is going to be small, your risk on the trade is going to be small. And then the fourth thing, you need to get out when it is the best possible time that you can maximize your profit. You don't want to get out too soon, you don't want to get into the trade too early, and you don't want to get out of the trade too early. You want to be in at the right time and get out at the right time so that you can maximize your profits. Okay? So you need rules, portfolio selection, optimum entry, optimum exit. Last but not least, you need, until you are comfortable with this, you need somebody to hold your hand every single day and says, for example, like SW, okay, SW, that's a good trade, but be patient here, or PFX, hold off there. This is this different condition. You need that hand holding in order to be able to see, in order to understand or familiarize with you or practice. You need the coach. So for example, if we discuss with you the rules, what the software does, it gives us first the portfolio selection. If you look at the radar screen that's in front of you, we can choose based on the radar screen what is the most opportune. So if I'm looking here, we're short the dollar Swiss from 96.40. It is now, we're up 6 pips on that trade. We're short the dollar CAD from 103, and we have no position in the dollar yen. Thank you. All right. And we can see that the best one that's moving is the pound CAD. So that would be one of the things I'm looking to trade this morning. The Aussie CAD is not. So right now you see the dollar CAD is going up. You see that the pound CAD is going up. You see that the Aussie CAD is going up. And you see that the Euro CAD is going up. So guess what we should be shorting, guys? We should be buying everything against the CAD. No, don't listen. Don't. You don't need the radar. You need to do your own portfolio selection. I'm not doing this presentation to sell the software, guys. I'm explaining to you. If you develop your own scanner, that's fine. We do what we do. We're in for-profit business. I mean, yes, we're in the business of training people. We're doing that. We're a for-profit business. But at the same time, I'm just giving you the ideas of how to look and do things. Okay? So we're businessmen, we're business people, and at least we have something that is of value to you. It's a win-win proposition. You see something that you can understand, you can define it, you can know what it works, how it works. It's not a voodoo, and that's what it's all about. Okay. So that the radar screen does that, and then to get to the timely entry and the timely exit is that I wouldn't know. No, he's always here. I mean, Boyke is one of the I really don't know who Boyke. I mean, I recognize the name. He's a very famous member of FX3, but I don't know him personally. This is something that expired. This is the Dow, the mini Dow. So right now it should be UM. Where we are, so the H11. So this is what it should be. We should be trading now the March contract. So it's downloading the signal right now. So all right, guys. So anyway, we got in a way you have to learn, get accustomed with it. No, guys, let's stay on topic. Please, Jasper and Boyke, let's stay on topic. The idea is, guys, we have to do, importantly, our portfolio selection, and we need to look at getting ourselves into the trade in the correct time and getting out of the trade in the correct time. So anyway, we have about what I would like you guys is, if anybody that would like to join us on our January 3rd online trade planning session, everybody in FX Seat is welcome as our guest. It's going to be on January the 3rd at 1900 GMT, and you can go there. I'm going to put the link for you. All what you have to do is just, oops, I wrote it, Raining Traders, yes. Training. That's brilliant, huh? Writing it wrong. You're very welcome to join us. The only idea, the only thing I just want to mention it, guys, is that we're expecting a lot of people to come in to this session. It's GMT, guys, and thank you, Tirko, and Testify. So if you just sign up, because we fortunately or unfortunately, because of bandwidth and actually costs, we're going to have to keep it as to first come, first serve. And if by any chance you are unable to attend, whatever, for technology reasons or whatever, the session will be recorded and it's going to be up on the website the following day. And again, thank you, Boyke, very much. What we're going to do is we're going to go through the year-end analysis, i.e. we're going to look at the very big longer-term trends, the trend changing points on the long term, because usually the beginning of the year, especially at the year end, I mean, you can begin to see new trends are You're very, just come in. I don't know who you are. Just send them an email, Abdul Najib. You begin to see the new trends developing. You begin to see the trend changing patterns. You begin to see how the market is changing from one mindset to another mindset. So that's what we're going to do in the January 3rd session. And as I said, all of you are welcome, and you can just go there and register. Okay? And with that, I don't know how long. We'll see you back in January. Thank you all, everybody. Merry Christmas. And Happy New Year. Happy and prosperous New Year to all of you. God bless you all. God bless you all, guys.